Convergences and key levels. Before we get started with the section on Fibonacci, which is next, it's important to understand convergences and key levels first and foremost. And we're just going to walk through some visuals here for you. But first, just want to give you a summary of some of the charting tools that we are going to be applying to the market that are going to be incorporated into, of course, this program, and they're going to be combined in various forms. Sometimes we may use only 2 or 3 visual factors, or we may use 4, 5, 6, or the whole spectrum of visual and then economic factors. So just want to walk through a couple of tools that we've got in our toolbox. So we've got trend lines, support and resistance levels, pivot point levels. We have various indicators, and they can be indicators of your own or indicators perhaps that I've introduced either in this program or indicators that we've introduced through the Pro Traders Club. We'll look at the global economic conditions and market sentiment. That is very, very important, by the way. Having an understanding of what is driving currency markets on a global economic level, and what is the market sentiment at the time. Fibonacci retracement and extension levels, candlestick patterns, the figure, pattern recognition or chart patterns and price behavior around those chart patterns. And of course, most of you will probably have personalized tools of your own. And I always say this, I can teach a class of 30 people, and I can teach them all the same thing, and I can mentor them for weeks on end, and I'll have them all in the same room for weeks on end and mentor them and walk through live trading scenarios. But every single one of those individuals will go on and become an independent thinker and trade on their own and make decisions on their own. And you'll all have personalized tools of your own that you'll want to employ and incorporate into what is being taught in these sections of the program. What is a convergence? We've of course addressed it leading up to this time, but we're going to get into some more detail. A convergence is quite simply, it's also titled a key level. We also call it a key level, which is a level of support or resistance where multiple levels of support and resistance are in alignment at a specific price point. And when I talk about support and resistance, I can talk about we can refer to fractals, and again pivots, Fibonacci, candlestick formations, trend lines, etc. As you've learned, support and resistance levels are identified by using our charting tools, candlesticks, trend lines, support, resistance, fibs, pivots, etc., moving averages, and other personally preferred tools. But a convergence occurs when 2 or more of these levels are in alignment at a specific price point in a specific currency cross. And what we're looking for is we're looking for a possibility of the market to bounce at these significant levels, or depending on market sentiment, we even may be looking for that significant level to break through. And it may be a core level that traders are on a global level are looking at and watching to see whether that level is going to hold or whether it's going to break. So we're looking for the possibility of a bounce or a reversal. When we apply this approach, it's very important to take into account the current trading environment, and because that can override what's happening on a technical level. Technicals primarily override or are more suggestive of the direction of the market, but the market trading environment as a whole, taking into consideration fundamental factors and economic factors, can override it, particularly if we have a profound economic report that is forthcoming or being activated at a specific time in any designated region. Look for a convergence or a key level as an area to place a trade. Here, for example, we have a level of resistance, and that level of resistance becomes support, and we also have this trend line, and we see a convergence of a trend line and a level of resistance and support. And we're looking at this area as a key level where price could potentially bounce or break through. Typically, if we see a significant trend in motion, then we would look for a bounce at this level. If we start to see reversal characteristics in the overall scenario, then we may look for a break in this level and a significant move resulting from it. As an example, we lift from these lows and look at the market characteristics. Look at how the test of the lows and then a subsequent rally. Resistance becomes support. We now start an uptrend. Resistance becomes support. Resistance becoming support, converging with the trend line, and a nice bounce. The following trading session, resistance becomes support again, converging with a trend line. We see a nice candlestick formation, weakness, with a failed attempt for the market to move below this level and hold below, and then we see a rally. We see resistance become support, and resistance is support, and resistance is support as the legs continue to move up. These areas are what are called, this is a very simplistic convergence. We are going to see a multitude of scenarios as we walk through the simulated trading environment where we will incorporate our Fibonacci's pivots, moving averages, and so forth. Just to give you a bit of a closer view of what that might look like, here we have a distinct level of resistance. Price moves through resistance, drifts lower on a natural retracement, finds support at previous resistance, and we see this somewhat of a minor or a junior trend line converging with the level of support, and then we see a rally releasing from this level. And again, resistance becoming support as traders and flows move above this key reference point and hold above, and as price trades above the 75.40 level. Just to show you what the larger price swing would look like, we see here that there are minor price swings, price here making lower highs and lower lows as it comes down to support, but we are in an overall large swing uptrend from this low to this high to this low and beyond. Let's look at a different type of scenario. The low holds, price rallies, resistance becomes support, another leg up, a parabolic leg up, no divergence in MACD. Look at this key level of support. We have a resistance becomes support, which is also a 38% retracement, which you're going to learn about in a moment. We have this uptrend line. So we have a multiple three factors, 38% retracement, resistance becomes support, trend line. And look how price drifts lower, and look how it sniffs the lows on this base of support. When that support is broken, acknowledged by the market, look at the move that follows. And look where it stops. Distinct level of support, price stalls. But this is very important. There's a couple important points in here, and that is, you see this base of support. That's why if you're trading long, you want to trade long as low to this basis of support as possible. That way your stop is tight in the event that this should occur. Again, when we do our analysis on our charts, we're ultimately looking for a convergence of factors that form key levels, and you're going to hear me using this term over and over again throughout the remainder of the course. And the key level is established when we're using multiple tools, pivot levels, fibs, support, resistance, trend lines, etc., and all of the other tools in our toolbox, whether they're your own tools or tools that I've introduced through this course. But we want to identify these key levels which may be presenting trading opportunities. And these trading opportunities may present themselves over an extended period of time where we may stock the trade, or they may present themselves in the market in a very quick manner, and we have to be very prepared for an opportunity to trade by watching price. And so they can be anywhere in the continuum. Either we have to be paying attention, and opportunity will present itself very quickly, or it may be a trade that we stock over a period of several days or even weeks. I will stock trades for sometimes weeks on end for long-term position trades. It is extremely important that we consider other market factors such as news, time of day, liquidity, upcoming economic reports in the various regions before making your trade. Convergences and key levels will present themselves in countless different ways. Every scenario would be different. Every trade that you ever make will be different and unique unto itself. It is important to acquire pattern recognition that will help you to identify where the market may bounce, consolidate, or begin to break down, because each one of these will present a trading opportunity. Bounce, consolidate, or break down. Okay? Bounce, consolidate, or break down. With the introduction of each analytical component, be it a tool, a chart pattern, some other idiosyncrasy about the market, they all have to relate to one another to give you a broader spectrum of the market, ultimately keeping in mind that you're looking for a convergence of factors to fall into alignment. And we're going to learn more about this. But again, the bottom line is this. Your most effective tool in trading in this market is a thorough understanding of the entire market environment, of the foreign exchange market environment. That includes global fundamentals. It includes all of your technical tools and the idiosyncrasies and the intraday price patterns, the daily highs and lows, support, resistance, pivots, Fibonacci, and so forth on the short term, intraday trading, the medium term, and the long term. We have to bring all of these factors into consideration, because we may see a beautiful technical setup, but the economic environment may not be trader friendly. There may be an economic report forthcoming in the next couple of hours, and we may want to stay out of the market because we may be exposed or vulnerable to some factors. So please expand your understanding of the market, and hopefully we can lead you to that throughout these courses, including the Global Fundamentals course that's available.